Hello, this is Professor Hazara again. This is the third video, 3 out of 5 videos on business combinations. Let's go through very quickly where we stand on this. Back to the slideshow. Okay, and the current slide is the last slide. In the last video, we covered this first one here, liquidation with goodwill. Okay, now we're going to cover liquidation with a bargain purchase option. Keep in mind that when we have goodwill, you end up with a goodwill number that was positive. That means you overpaid. In this case, we're going to end up with a goodwill number that's negative. That's when it's called a bargain purchase option, when it's negative. Okay, so I'm going to go right here and go right into the video. Okay, so go right into the worksheet, I mean. Okay, so here's the worksheet. Now, I'm going to go ahead and start by comparing what we did in example 1 with what we do in example 2 here. Okay, so in the combination, in the business combination with goodwill, liquidation with goodwill, we had a company, had total expenses of $140,000. And let's see here. This was their balance sheet. Pelican bought Seabird. Pelican paid a lot for Seabird, $825,000. The net book value of Seabird is $520. And that means you overpaid. You pay $825,000 for something that's worth $520 on the books anyway. And keep in mind that $520, I'll just show you one account, is really the sum of the 3 equity accounts of Seabird here. Okay, so you're paying $825 for equity or net assets. Equity and net assets are the same thing. Net assets are assets less liabilities. Seems to me that equals equity. Okay, so anyway, so the difference, you overpaid by $305. And what we're saying with goodwill is that we're saying there's 2 reasons why you would overpay for a company. One is that specific assets and liabilities have fair values that differ from the book values. So we've overpaid by $305, and we took out the reasons for the overpayment. That's why we subtract from this $305. We subtract amounts where the fair value is less than the book value. We do that because we're trying to take out reasons for that overpayment. We're saying we overpaid for $305. In this case, accounts receivable, you paid $40,000 more because they were worth $40,000 more. Same thing for inventories worth $50,000 and land for $100,000. Okay, and these ones where the fair values are less actually are underpayments. You pay less for accounts receivable because they were worth $10,000 less than their book value. Okay, so in your negotiations with the other company, you would underpay. So that would have brought the number down, this 305 down from some larger, from 315 really. So anyway, so that's why we do this. And so you may want to, these rules are very important. It's if for assets the fair value is greater than the book value, then subtract. If the fair value is less than the book value, then add, which is the case right here for equipment and accounts receivable. And then for notes payable, for any liabilities, do the difference. Do the opposite. If the fair value is greater, add it. Fair value is less, subtract it. And you'll notice that what we're doing is we're subtracting all the reasons why you would pay more for a company. All the reasons why a company's value would go up. Company stock goes up when its assets are worth more than the book values. So we overpaid, and we're trying to subtract those out so we can isolate goodwill, which is the amount of the overpayment, which you cannot identify with any specific asset. Okay, so let's go down here. You'll notice that we had 3 journal entries. One was to record the investment. One was to pay the cost, which is, I wouldn't say it's trivial, but for us, it's not the major thing. And then we had this entry. And in this entry, what we did was, one of the first things we did, I don't know if it came out the rush way I did it, my computer was on a blink, that's why I rushed that through, is that we debited the investment when we bought the stock, but then we decided to liquidate the other company. And so when we liquidate the other company, we throw the stock out. So we make that 825 0. So this 825 becomes 0. And then we brought all the assets down at their fair market value. So every asset here we took off of the fair market value. You see cash right there. That's true for all the other assets. We took them from the fair market value column of the of Seabird's balance sheet. And then finally what we did, this is basically accounting 201. We had 3 journal entries. And what I did was I basically, for each one of those entries, I just, in a sense, posted it to the T account in a sense. It's a worksheet. It's a worksheet. So all these entries come from, all those numbers come from entry 1, which is this entry, entry 2, which is entry, or entry 3, which is that entry. Entry 3 is really the most important one. And when I added across, I got what I said we would get for a combination with liquidation. We got a larger company, and there's only one company. It's Pelican. Okay, so you would call this. They would issue an annual report, and it would be this larger company here. Okay, then we come down to. We're going to do this combination. Now, this is the exact same example. There's no difference in the 2 examples except for one thing. Here we paid $8.25 for Pelican, and it was all consist of stock, whatever else. So we paid $8.25 here. Everything's exactly the same in the 2 examples, except over here we're only paying $6.25. So I'll come over here, and we're paying $6.25 all cash, which makes it easier. I'm just going to have to credit cash. So you're paying the shareholders of Seabird cash, all cash. Let's see how it's supposed to be, but anyway, you're paying $6.25. Okay, so here we go again. Same fair values. Here's the balance sheets. Here's the cost, except you're paying $6.25 in cash now. Okay, and so let's go ahead and compute the goodwill again. Now the cost here is easy to calculate because the cost, keep in mind that the cost, and I'm going to go ahead and emphasize this again, the cost on any combination is, the cost is equal to the fair market value. I'm going to go ahead and copy this. The cost is equal to the fair market value stock issue plus any cash paid. So we're going to go here and we'll put the cost rule out here. Okay, so the cost here, the only thing, the cost here is only $625,000 cash paid. The fact that it goes down is not a coincidence. Okay, and then the book value is going to be exactly, everything's going to be the same. Everything's going to be the same, but there's going to be sort of a slight difference that sort of goes through the example because we paid less. It's going to sort of find its way through the example. So we have common stock of 300,000. We have additional paid in capital of 50, and we have retained earnings of 170. Okay, so as logic has it, the fair market value is the same, and we got to put this in. We got to say that this is negative because $520. Okay, and so here's the difference is if we add these two together, we get 105. So we do overpay by 105 here, but we may have enough negative amounts here, so we end up with a negative number for goodwill. When you end up with a negative number for goodwill, then it's not goodwill anymore. It's going to be a bargain purchase gain. Okay, so let's compare this. We have 105 here, and our amount, it's $200,000 less. So we're going to use the same numbers in the middle here. All these numbers are going to be the same. I'm going to recreate it just so that you can see the process again. But it looks like we may end up with a negative number here. Okay, so anyway, let's go ahead and we'll put the fair values first, and we'll put the book values second. I like to repeat a little bit because you'll see, in case you didn't catch something the first time, you'll catch it now. They're basically the same problem, except for the bargain purchase option. Okay, so the fair value for cash is 30,000, and the book value is, wait a minute. You don't need that cash. You don't need to put in amounts for which the fair and book values are the same. Okay, so accounts receivable. Accounts receivable, fair value is 40. Value is 50. These are the same numbers from last time. but I'm going to do it just a little slower this time. Okay, for accounts receivable, for inventories, the fair value is 120. The book value is 80. Then for land, the fair value is 150. The book value is 100. Then the fair value for buildings is 300. The book value is 200. Then for equipment, the fair value is 250, and the book value is 300. Okay, then we have a note payable and goodwill. Okay, and then we'll do the adjustments. Okay, the note payable is 180, and the book value for the goodwill is 200,000. Okay, keep these rules in mind. If for an asset fair value is greater, subtract. If it's less, add. Opposite for liabilities. Okay, so this is going to be the fair value is less here, so we'll add it back. So we can do that one of many ways, but we just take the greater number, so that's 10,000. We'll add back. And then I believe for these next three, they're all assets for which the fair value is greater, so we'll subtract out. So I'm just going to go ahead and copy these down. It'll be 120 minus 80 gives you negative 40. And just to keep make it a little more efficient here, I'll go ahead and subtract those out. Okay, then note payable. For a liability, if the fair value is less, then subtract it out. Now, the fair value is less. That makes the company worth more because they owe less. If you owe less money, that means your stock is worth more. Okay, then, so we will just we don't need to put a negative in front here because the fair value is less anyway, so negative 50. Oh no, we should add that back. If the fair value is less, then subtract. That's equipment. What am I doing? That's equipment. So sorry. Oh, sorry. Okay, so this is an asset. So that should be, if the fair value is less, add it back. I had to see that. We'll just do that. And then for the liability, we'll just take 180 minus 200. That gives you negative 20,000 there. Okay, so let's see how much we get for goodwill. And here's the big difference is that when you have a bargain purchase option, your goodwill is negative. Okay, so let's go ahead and just sum these up right here. And we do want to in fact, have a negative number for goodwill. So when you have a negative number for goodwill, it's not goodwill anymore. It's a bargain purchase option. So I'm just going to put here bargain purchase gain. I keep calling it bargain purchase option, but it's a bargain purchase gain because it's negative. So if this number is positive, you have goodwill. It's an intangible asset, which you don't write off, by the way. If you have a negative number, it's a bargain purchase gain, and we're going to call it like a gain. The reason we call it a bargain purchase gain is because it seems like you got a bargain on this deal. You were able to get, I don't know what the fair value is, but you were able to get this company for $45,000 less than its fair market value. That's what that means. Okay, so let's go down and record the entries here. Okay, so we'll put the debits here, the credits over here. Okay, so we know that the cost of the investment is $625,000. So we will put in $625,000 there, and we know that the cost of the investment was just cash, which makes it simple, $625,000. So that's to record the investment. That's to record. I should really say it is to record the investment, but it's to record your purchase of the stock. Okay, next one here is we know the costs, these expenses, we know that they are equal to, we know that the expenses are equal to $140,000, and we'll just go ahead and expense those, and we'll take them out of retained earnings last time. And then we have to liquidate the other company. Now, this description is from the other sheet, obviously, that I did. And we have to liquidate the other company, bring the assets over to the balance sheet, record. But I'm going to put here, record bargain purchase gain. I'm just going to go goes to retained earnings. Okay, and so the entry that I'm going to make here is very similar to entry number 3 that I made in the original example here. So you can compare the two examples. They're basically the same. I'm going to bring over all the assets. I'm going to bring all the assets over at their fair market values, and I'm going to write off the investment to make it 0. The big difference is, though, that the plug, Goodwill was a plug, basically. The difference is going to be on the credit side because we have a gain here. And that gain is then closed retained earnings like any gain would be. Okay, so let's see what we have here. All right, let's just go down the balance sheet. I'm going to go ahead and put, well, let's see what we get. Okay, so the first one is, go down the balance sheet here, cash. I could probably just copy, but let's see what we get here. Accounts receivable. Inventories. Land. Buildings. Equipment. These will probably be credits, so we'll have to move them over a little bit. Accounts payable. Notes payable. I don't know why that's notes payable there. Okay, and then we're going to finish with the investment account, which we're going to write off. And then we're going to have, let's not forget our bargain, I'll just call it a bargain gain. And then these are going to be credits here. So I'll go ahead and move these over. Whoops. I'll just write them in. Okay, and so that'll be the entry. And what we're going to do is bring over all the assets over to fair market values, and the difference should end up with a gain. And we're going to write off the investment account. Okay, so let's start with cash. Debits will go here. So cash is fair value is 30,000. Accounts receivable, the fair value is 40,000. Inventories, the fair value is 120. Land, fair value is 150. Buildings, the fair value is 300,000. Equipment, fair value is 250. Actually, a write down of equipment. We're bringing over a fair value is less, so we still have to debit the account, but it's write down of the fair value. Okay, the accounts payable, the fair value of 40, I think, if I remember. Notes payable has a fair value of 180. Okay, the investment, we're just making it 0. We're just going to make that number 0. Don't forget that part. Now, I'm going to go ahead and total this entry like I did last time. 890. And I'll just go ahead and copy that over. Okay, so the difference is 45,000. And so if I go up and bring down my bargain purchase gain, there it is, 890. So I should equal. So as long as my beginning balance sheet equals, which it does, then I should get, and my journal entry equals, and the balance sheet, the post-acquisition balance sheet should equal. Okay, now, I did this very fast last time, so I want to make sure that you understand that this balance sheet here, all I did was copy it down from here. This is the parent's original balance sheet. The parent's going to buy a company, buy the stock, bring over the assets, and then just come up with your balance sheet. Remember, this is still a liquidation, which means you only have one company afterwards. Okay, so let's start with entry 1 this time because it's so easy. Entry 1 is a debit to investment and a credit to cash. So entry 1, this is my reference column, by the way, is a debit to the investment account. Entry 1 is a debit to the investment account, misspelled, and a credit to cash. Now, in this particular problem, you end up with a negative balance in cash. And the students kind of get flustered with that sometimes. I wonder why. The fact is, it means you're overdrawn. You probably have to draw on a lot of credit or something. But I wouldn't worry about it. Okay, so you have a credit for $625. Okay. Then, let's go to entry 2 and get that out of the way. Now, entry 2, I'm going to do the same thing as I did last time. It's an expense. I'm just going to close it to retained earnings. Okay, so this is entry 2, and there's a debit to retained earnings. You close all expenses for retained earnings eventually anyway. Okay, and then we're paying cash for that. So in entry 2 here, we're going to have a credit to cash for 140,000. Okay, so we've posted those 2 entries. And I'm going to go ahead and just sum these things up. So I want to make sure that as I go through these, I'm at least putting in the right amounts. My debits equal my credits. Kind of important point. Okay, so 675. Okay, the rest of these are entry 3. Now entry 3 is going to be it's going to be to almost every one of these accounts because we're writing assets off. Okay, so I'm just going to say here 3, 1, and I'm saying that we're bringing over $30,000 in cash. Now, in real life, companies don't bring over cash; they just reduce the purchase price. They do it net of cash. But I'm just leaving that point out here. Okay, and then this is 3 also, which is a debit to accounts receivable for $40,000, and then this is 3 also, which is a debit to inventories for $120, and then this is 3 also. They're all entry 3. This is a debit to land for $150. 3 also. This is a debit to buildings for $300, and equipment is equal to a debit for $250, I think. That one over again. A debit for $250. Okay, and then I'm bringing over liabilities too, and keep in mind with those credits, I'm writing up their liabilities. So, and this is entry 3 also. I am going to credit accounts payable for 40. There should to accounts payable for 40. Credits to notes payable for 180. Then you got to follow the entries. Remember, accounting is all about following entries. And so from entry 3, and I'll just put 1, 3 here, saying debit comes from 1, the credit comes from 3. There's a credit to the investment account for 625, which makes it 0, by the way. And then finally, in entry 3, there's the bargain purchase gain. Bargain purchase gain, I'm going to go ahead and close retained earnings because it's a gain, and gains and revenues and expenses and losses are all close to retained earnings. So I'm just going to go ahead and say 2, 3. 1 came from entry 2, the other one came from 3. Okay, so bargain purchase gain for $45,000, and you'll see that my entries add, so there should be no problem in putting together my post-acquisition balance sheet. But notice that Goodwill, I could even take this line out, but Goodwill is a flat 0. There's no Goodwill here. Instead, there's a bargain purchase gain for $45,000. Okay, so I could even do this. See if there's a way to. No. Anyway, forget I had a little thought there. So this is the total. This is the balance sheet that Pelican would present to its shareholders, and it would be called something like 10K Pelican, the balance sheet of Pelican Company and subsidiary, or something like that. Okay, so all we've got to do is for assets, take the beginning balance, add the debit, take out the credit. So we end up with negative 445 with cash. No sweat. Students all the time complain about this example, but no sweat because they're overdrawn. They have to go ask a bank for money. Happens all the time. Yeah. Okay, so let's go ahead and copy that down. So our investment ends up at 0, which is what it should end up with because you invested $625 in entry 1, but then you threw the stock away, and then rather than keeping the stock, you threw it in the garbage and brought over all the assets and liabilities. So 625. Okay. And let's see what the sum is here. I'll just do sum. $2925000. By the way, that is the correct number. Obviously, I have notes with me. So we have that amount. And so the new company would have, it would be one company because the other company was liquidated. You have $2,925,000. Okay, then we've got accounts payable. We'll just do liabilities. It's the original balance plus the credit minus the debit, counting 201, folks, $340,000. And we will copy this amount down and see if we get the same number. I don't want to have to do an audit here. 2925. So let's compare the two things, the two examples here. Here, let's compare the balance sheets. Here you had Goodwill of 155 in the end. Here you had 0 Goodwill in the end. Here, but you did have a bargain purchase gain, and that originates from this negative number up here, which was entered into that entry right there. So there's no Goodwill in this entry like there was in the first example. Here we had Goodwill in the first example of 155 because we had a positive number here. Whenever you have a positive number here, it's Goodwill. When you have a negative number in your Goodwill calculation, right here, it's a bargain purchase gain. Anyway, so I think this should help you a lot. What I'm going to be doing, and I think you'll see as the class goes through, is I'm going to actually put these lectures online. I think this is still early August. It's 1:52 a.m. August 5th. What I think I'll do is maybe we'll actually have lectures for the class every 1 or 2 days, even 2 days if you want. You can attend or not, but then you can also refer to the to these video lectures if you want. So you either way, it's fine with me. But there'll be homework that'll be due every week or so, and we'll have, you can call me or whatever for chats. We'll figure it out. Anyway, so I'll go ahead and post this to YouTube, and hope everybody's safe in these rather strange times.